California. So welcome everybody. Good morning. We start in Singapore with our regular commentator, Vandana Hari, founder and CEO of Vanda Insights. Vanda, I see in your newsletter, views letter this morning, your headline, crude sentiment caught in a time and geographic deadlock. Time and geographic deadlock. It nearly sounds like something Richard just said about how he prices storage, but that was far too complicated for my mind. Vandana, your thoughts of the market this morning, oil prices rising in Asia.
Yeah, thanks, Sean, and a good morning, afternoon, evening to all our viewers. It does feel like that, and as I was writing that report last week, crude had been in quite an impasse. Brent very range about around $63. We see it. I think it's around 64.50 as we speak. But I don't see a major bullish impetus just yet. So I'm not sure if I'm missing something, but I did mention a time disconnect, if you will, because there seems to be this tussle between the glass half full people in the market saying it's just around the bend, the good times, we're moving past COVID, and those looking quite pragmatically at the current situation with the resurgence in COVID and all the problems we are having with vaccines rollouts as well, unfortunately. And of course, geographically, I see quite a divide as well. So we continue to see quite a lot of optimism over US economic growth. And we see at the same time a bit of pessimism over Europe being able to get out of this mess. So, it's just that tug of war which has left crude quite deadlocked. That's the flavor, I feel.
Richard Ridoglia, Chief Executive Officer of Matrix Global Holdings. The market is getting a little bounce this morning, Richard, on OPEC's report yesterday, where they sort of redrafted their outlook for demand recovery, a slightly more bullish picture presented, whereas only as recently as 2 weeks ago, they had downgraded their demand recovery outlook. A little bit confusing, or are things changing that quickly at the moment?
I think it's changing like it's supposed to be changing. We don't really know. It's 70,000 barrels. I think I listened to Helmut Croft's discussion on your halftime, and I had talked about it before, and I talked about it back for Platts in Amsterdam a while ago. And I think the thing that we're seeing is this remarkable thing called a Zoom OPEC meeting. And in real time, and Vanna just talked about it, in real time, we are seeing the largest producers of the world adjust their supply, and it makes news, 70,000 barrels. And the reason it's important is in 3 weeks, they're going to tell us what they're going to do with supply. And I think that to me is the most remarkable thing that we have seen in the last number of decades.
But Richard, my question to you, is that because the market is completely clueless? And so OPEC has this ability to spin on a dime. I'm going to 70,000 barrels. I'm not. I mean, we saw 3 meetings in a row now where most expectations were way off the outcome. So the market's sitting at the edge of its chair, traders, analysts, tea leaf readers like ourselves saying, we've no idea where this is going. And hence, maybe there's a lot more power in OPEC's hands.
I think that's it. That's it. I think everybody's been trying to look at the past, and I would argue that this is the new future. As I was saying earlier on or before the call, I ran Merrill Lynch in the 80s and 90s. We hired a guy with a cell phone to go sit outside of Vienna press conference and listen to what OPEC was saying and call us on his cell phone. Now we're watching it in real time. But the more important factor is not just OPEC, it's the advances in information technology. Right? We have Kepler. And if you remember, OPEC's biggest problem was compliance. That was the number one problem in OPEC in the 80s and 90s. And Sarah could maybe talk about this. Was OPEC compliance as a function of cheating. And that's what caused the rifts. And that's what caused OPEC always to break apart. 80s, 90s, you go back any of the major moves. Well, Kepler just watches the cargoes load and then tracks it until it lands in the refinery in China. right? So it's technology there. And then secondarily, or equally as important, is the fact that demand function is known in real time. We know how many flights are taking off. We know what gasoline demand is. So now we know what demand is in real time. OPEC is adjusting supply in real time. And every merchant oil trader in the world has an AI system that calculates it. And that's, I think, where we're at. And so we'll find out this next OPEC meeting what they do.
Sarah Akbar, Chairperson and CEO of OilServe Kuwait and Non-Executive Director of Petrofac. First, Sarah, may I wish you a Ramadan Kareem and thank you for joining us again. Your thoughts on the recent OPEC decision and this concept Richard is speaking about, where they literally have this sort of monthly ability, although on the last meeting they did go 3 months out with a roadmap, but yet are meeting again every month. That where a country like Kuwait and others, can they hold this together, do you think?
Yeah. Good morning, Shane. Yes, I think they can, and simply because this is truly the new world. As Richard was saying, what COVID did actually, it accelerated the future where you have real-time data all the time and you can change your demand supply game all the time. Now, on the demand side, as Richard was explaining, it is much easier now to see how demand is changing almost daily. So you have that picture very clearly. On the supply side, what is helping is that you have closed supply. You have surplus capacity that is sitting on the side that can be brought in at any minute. So it is a truly real-time management of the market, and it is in the hands of OPEC plus at this point in time. So what the expectation is, as long as we have that demand, that supply surplus sitting on the side, you will continue to live in this world. When things start to become tighter, which they will, then it will be a different ballgame. The game will change. But until you consume the remaining 6-7 million barrels that are sitting now closed capacity, you will still be managing the market in real time the way it is being done now. And it is the most rational way.
Vandana, looking again, I really liked the graph or the infograph you used in your newsletter on the IMF outlook for big oil consumers. India with a forecast of 12.5% GDP growth. It's been a massive number, of course, perhaps coming from a low base of negative 8% last year, but nonetheless, all of these economies are in some scale of significant growth this year, but we are seeing some cracks in the crystal there. That obviously India suffering a very significant resurgence of COVID. I mean, some of these GDP numbers may not be reached if indeed we do see another resurgence. How fragile do you think this moment is, this sort of coming out of the COVID forest is, as we go deep into the second quarter?
Yeah, and that's exactly what I was intending to point out in that infographic as well, that China, US, India, 3 biggest consumers of oil, all flagged for very strong GDP growth rates in 2021 by the IMF. But if that doesn't pan out, then conversely, their oil demand may not grow as much either. We did see India's March consumption at, I was just looking at the figures, about 4.83 million barrels per day. Of course, it's a distant third behind the US and China. But that figure, you might be interested to find out, is the highest since November 2019. So not only did it go back to pre-COVID, but pre-COVID. And that did get the markets excited a little bit, and rightly so, because, Indian economy was well on its way to opening. The idea was that the worst of the wave that India saw last September was behind the country, but, lo and behold, here we are today, very, very unfortunate. The 7-day running average in the country of daily cases is now about 140 93,000, which is, far surpassed the September peak of about 93,000. So things aren't looking very good. And while I agree completely with Richard and Sarah that we are in a very real-time world, we are monitoring, or at least trying to monitor demand on a real-time basis, OPEC modulating supply on a real-time basis. But I think the biggest paradox in the markets today is that while we're wanting to do all of this in real time, we have absolutely no clue where COVID and this sort of stumbling with the vaccines is going to take us. So, I think the forward picture of demand, I think that is keeping us and will continue to keep us on tenterhooks.
Richard, the big sort of question, or that's nearly baked into the expectation now, that the US will be the big sort of mover this year, while Europe struggles, India may struggle. We already know China is living in a post-COVID world, but the US was the next major economy to get there. And yet we see overnight Johnson & Johnson vaccine being mothballed. We see in, I believe, something in the region, COVID cases are rising in more than half of US states. I'm wondering your own thoughts on the vulnerability of where America is now, where the Fed chairman expressing some caution that there is this tipping point. Can America get beyond COVID with vaccines?
Yeah, yes, I think so. I think that the accommodation and the printing of the trillions of dollars is going to wash out any issues of demand. People are getting tired of staying at home. We're seeing the roads are much busier now. California is a state that's tended to be locked down, and an hour and a half drive to LA took me 2 hours and 40 minutes the other day. And I think that's a great guide, because it is a classic corridor. So I think that we will see demand on the rise. Our gasoline stocks are at the low end. Our distillate stocks are coming back a little bit. Utilization is now 85%. So we're going into a non-turnaround season, I would think. That it's really something that we are looking at returning to normal. So not being a doctor, I think that from the perspective of the public, demand is on the increase, and people aren't going to sit back and say, well, I've got my vaccination, I'm going out again. So I think it's going to roll out, and it's going to roll out pretty fast. I think we're up to 3 million vaccinations a day now.
I mean, it's also worth noting that 1,000 people died yesterday in the US from the COVID illness. So it's still not an insignificant number, but obviously way down from the highs it was earlier in the year. Sarah, right. The other challenge in this region where we sit overnight has been another vessel has been attacked, has been sabotaged off the Omani coast, the Omani Sea here. We also have this uncertainty with the growing tensions around the Iran-Israel peace. Your thoughts on the outlook, the geopolitical tensions rising, and again, having very little impact on the oil price?
Well, yes, you are absolutely correct, John. The geopolitical picture is continuously getting more tense as we move on. And, it's all now either third-party proxy wars or these direct attacks on the ships. We had one in the Red Sea, we had one now in Oman, on the Arab Sea, and we had this explosion in the nuclear plant. So it is intensifying. And I think all is this related now to the discussions that is actually happening between the US and Iran on the treaty, the agreement. And so it is like the last minute kind of tension before we get that agreement and things slowly get back to normal.
That's the optimistic view. That's the optimistic outcome. The glass half full, the last flash before the new dawn.
That's exactly. I think that's where we are, because the US is adamant to sign an agreement with Iran, and I think the Iranians want it badly as well. So on that
do you think the Gulf Arab states will sort of come into line with that?
well, they will have to. They will have to. We don't want to see more tension in the region, and it is in the best interest of all to have some cool down on that front. So Iran has been a big issue for all the region, and the more the tension, the more it is not good for anyone. So any kind of agreement that can settle things and keep things safe for a while, I think will be welcomed. Yes, all the GCC wanted a seat on the table for the negotiations. They wanted their own input into these agreements, but maybe through, again, proxy, they can do that as well. So let's see where we end up with. But I think that agreement is imminent, and all this firework is just before that agreement. I think so.
Vandana, in China, we've seen the numbers this week in terms of the March demand, imports year on year grow quite a lot, but month on month pretty much remain even. There is some concern in China growing about inflation and whether there should be a tightening of the credit availability from the banks. Where do you think the outlook for that is going in China as it sort of moves forward with what is forecast to be a stellar economic growth year, controlling inflation?
Yeah, I think the asset bubble worries for Beijing have been around for a while now, and clearly with last year's easing of credit, they grew even larger. Even the government has been and wants to be very thoughtful going forward as to in which areas the easy money is funneled into. Clearly they don't want an overbuilding, the ghost cities that we've been talking about for nearly a few years now. With regard to Chinese oil demand, it was also being mentioned by some of the guests on your shows earlier this week that it would be probably more prudent to see it on a month-on-month basis, which is not a big increase because of the base effect of last year's ups and downs with regards to COVID. I do feel sort of a moderating of Chinese crude imports is par for the course. We also, and of course, in the very short term, they have the seasonal maintenance season as well. So, that'll curb appetite a little bit as well. We've also seen headlines this week of the government going after the very, very small, marginal, not very economically run so-called teapot refineries. Again, this is nothing new. It's almost comes and goes in waves. But it's, having looked at this issue a little bit a few years ago, it's actually far more nuanced than, what appears at first blush. The state governments actually give a lot of support to these refineries because the tax from them goes much more to the state government. So we shall see, but there might be some trimming because we know China has been putting newer, bigger, more complex refineries. So there might be some trimming that happens at the fringes with regards to the teapots. But in general, I think also I keep cautioning my clients as well not to read too much into Chinese crude imports, because higher crude imports are also translating into higher products exports. So if you're looking at a global balance of oil, even a double-digit growth in Chinese crude imports doesn't mean Chinese demand is growing at that rate. So good to be a bit cautious there.
Richard, we see the markets moving up this morning in Asia on the back also of the outlook for a drawdown in stocks in the US. We've now seen the API report overnight confirming what Reuters had previously signaled in their survey, and Platts had also signaled 3 million barrel draw. API have gone to 3.6 million barrel draw. Nonetheless, give or take a few 100,000 barrels, this drawdown continues in the US. Your outlook for that, I know you had a big auction recently on storage space. Where do you think that's going?
The drawdown is continuing. I think it's a one-way street at this point, and OPEC is in control of that. Crude shale is not going to come roaring back. We saw the washout. that everybody, the money changed hands. It went from Occidental to Chevron, from I think EOR to Exxon. And so where companies were initially going to pump up the shale market on the basis of cash flow, now what's happening is the major are building extremely large pipelines into the refineries in Houston. And so I think that the balance is there. We're effectively out of balance. Shell, I'm not sure if you're aware of this, tried to sell one of its larger refineries, the Convent refinery. No one bought it, so they mothballed it. So that was a huge consumer of medium sour crude in the Gulf. That crude is not going to be exported out to the medium sour demand that's out there. So I think we're looking at the U.S. really is following the path of the rest of the world. I noticed
we are getting quite close to the 5-year average. Do you think, given the outlook of where we're at, that we could actually move below the 5-year average on inventories?
I think we probably will. What's interesting to note is if you remove March of 20 to December of 20, you just kind of move that away. Our crude price now, both Brent and WTI, is in the middle of the range of going back to 2017. $64 is almost the exact middle of the range going back 5.5 years. But equally important is volatility is trending down. It goes back even to 2015. I think the Brent volatility got down to 30%. And to me, volatility is really the pulse of the market. It's where profits come from. It's where people make their decisions. And when you do what I believe is happening with OPEC, you effectively crush volatility, the market starts to find equilibrium. And I think we're in this upward trend, but it's had this kind of volatility being really put under pressure. And what it does, it tends to put real pressure on storage because there's no reason to store. If there's no volatility, you just keep on drawing down. And I think that's the two major things that we're seeing right now.
Sarah, of course, the where the rubber meets the road on all of this is for this Gulf and for the oil producing countries within the OPEC plus, in order to manage their fiscal position. Kuwait is probably at the extreme end of the stress of that. I would welcome an update from you on the liquidity crisis that Kuwait faces with the depleted oil revenues. You're on mute. Sorry, Sarah, you're on mute. Yep.
So, the sources of income in Kuwait are like three sources. One source is the oil revenues. The second source is a little bit of the services and the taxes. And then we have the sovereign wealth fund, which has a good return. It's about $600 billion sovereign wealth fund. Now, traditionally, in the past, we were not using any of the money from the sovereign wealth fund. It has to be by law, and the parliament has not.
Is that what you call the Kuwait's Future Generations Fund?
Exactly,
Right.
yes. It is the Kuwait Generations Fund. So we don't use any of that money because by law, if the government wanted to use any of that money, they have to pass a law, and they've never been able to pass a law. So in the last few months, what the government did to resolve the liquidity crunch, because they were not able to issue the debt. We could not, because even to issue the debt, you need the parliament, and the parliament would not, help the government. They were looking to raise something like $75 billion from the market in debt, because currently they have no debt. And that's a big issue for any government, to have no debt. So the potential is huge here for the government to get access to debt, and that will solve.
Like we're seeing in the other Gulf states are accelerating their debt.
Correct. But we have not been able to make that step because of the political turmoil that we still live in. But the reality is, if the government wanted to access liquidity, they would have to take some money from the Future Generations Fund to resolve some of these current short-term issues. But on the longer term, I think it's an economic problem that we have, relying on a single source of income.
And also sort of guaranteeing employment to so many graduates, it would seem to put the government on an unsustainable path. Let's get this survey question done before we run out of time this morning. The question is, can oil prices return closer to $70 a barrel than 60 on demand recovery in China and the US, while India, Brazil, Europe continue to labor under resurgent COVID-19 infections? i.e., we are seeing, and the projections of an uneven economic recovery in the world, US and China surging ahead into new growth, but others still in very difficult. Will the oil markets reward simply on the back of China and the US while others labor? That's the question for the room. Vandana, your thoughts, outlook for the rest of the week? We're halfway through. The markets have been very mixed, sideways, if you like, looking for direction. Where can it come from? Are these inventory data going to be the trigger to move upwards?
Yeah, before I get onto that, I paused more than usual in your survey question. I wanted to say yes, but then I said no. The reason for the pause was that I think a big part of that equation is going to be, what does OPEC do in response to this kind of duality in the world of demand suppressed in one half and going up in the other. I do feel that I
suppose OPEC, China and the US are the two 10,000-pound gorillas.
Yeah, but then I think the optimism with regards to US recovery right now is far higher than with regards to China. Somehow, I think a lot of Chinese demand-related optimism was already factored into the markets through last year. So ultimately, I answered no, because my personal feeling is that OPEC will continue tapering gradually. They're not going to hold back supply, even if demand doesn't quite pan out in the most optimistic scenario. Back to your question, I think we have the IEA report today. So we've had the EIA monthly outlook. We've seen the OPEC monthly outlook. So the market will be looking to what the IEA, the International Energy Agency, thinks about, and whether it revises upward again the 2021 demand, just as the other two have done. I think it was interesting that OPEC actually revised down the Q2 demand growth, or rather demand versus last month's reports, and EIA did the same. So to my mind, that's a little bit flies in the face of OPEC actually planning to put more oil into the market through May to July. And of course, the EIA report, I think, as I've been saying, as much as the stocks, I think the attention will also be on US oil demand. I think last week, the figures on that were a little bit disappointing. But I think the market will once again be focusing to see if how, especially gasoline demand, what the trajectory is looking like.
Richard, I'm not sure if you're still with us there.
I'm here. Yes,
you are. I just wanted to get your views on closing views where the market goes this week, but particularly, does Biden have the political cover domestically to do a deal with Iran at this moment?
I think he does. I mean, it's our country is polarized. Whoever's in power, they're going to do what they want to do, and so I think politically he will make a move to do, and we'll find out what it's going to be. Right? Is it going to be kind of a mutual agreement where they come out and one says, we're going to reduce sanctions for whatever Iran's going to promise to do, but he does have the coverage.
Okay, let's get the survey result and give Sarah the last word this morning. Boom, there we go. We got a 50-50 room. That's the start, sort of plays into the sentiment that I said at the beginning of this. Nobody has any idea where this market is going, and hence Sarah gives OPEC plus, even with 8 million barrels of idle capacity, the appearance of a tight market. You're on mute again, Sarah. Last word for you.
Yeah, I think, people should look at Bitcoin rather than the oil market.
much more fun to look at Bitcoin.
That's why we have it in our headlines today at surging above 60,000.
Yeah, because, I mean, it has a similar trajectory to the oil prices, and I hope one day that we can follow that same kind of trajectory. But I think at this point in time, we are really living in a bull market. And as long as you see this economic growth and the big change in the US, I think it will be sufficient to keep the prices at these levels. These are the major two economies of the world, China and the US. And if they are both on track, then I think there is good basis for continuing to see the prices at the same levels as expected here.
Well, we will leave it there and point, we're just posting an interview, our halftime talk this week with Mark Otzwald, sort of painting what he thinks are some of the challenges as the countries and the global economy emerges from the COVID pandemic. As you can see in the headline, we're going to have a very uneven recovery. So that's a useful 20-minute interview if you have time. Thank you, Sarah. Thank you, Vandana. Thank you, Richard, for your time and insights today. Really appreciate it. Have a great day, and we'll catch up with you through the rest of the week. All the best. Thank you.
Thank you.